So welcome to all of you Shiksha 360, and today basically we have to discuss the chapter number 6. We have to discuss the chapter number 6 and MCQ set number 15 that is related from with the chapter number 6 question from 195 to 209. Clear question basically we have to discuss from 195 to 209. Clear. So in this session basically part 1 chapter number 6 part 1 which I have already provided to chapter number 6 part 1 part 2 and part 3 clear plays an important role while discussing the question. Clear. While discussing the question, chapter number part 1 part 2 and part 3 basically plays an important role. Clear. So without wasting much time, so let's start our discussion. Question number 195 basically presents in your screens now. Clear. So the risk that the buyer faces relating to the seller. Clear. Basically the risk that the buyer faces relating to the seller not shipping the goods after receiving the advance payment. Clear. The risk that the buyer faces, basically faces relating to the seller. Clear. Not to shipping the goods. Clear. Basically that the seller or supplier not shipping the goods even after receiving the advance payment. That is basically depends upon the depends upon the seller. Clear. Basically it depends upon the seller basically that they are not providing the good. So basically which type of risk it is: seller risk, buyer risk, shipping risk, credit risk. Clear. So basically it is basically from the seller side, so that is basically known as the seller risk. Clear. So this risk basically it is known as the seller risk. Clear. Now move to the next question. Question number 196. Very important question. Clear. Very important question. We have to discuss in detail regarding that. Clear. So as per the ECGC country risk classification. Clear. Basically as per the ECGC country risk classification, which of the following category does not match? Clear. So as per the ECGC country risk classification, which of the following category basically does not match? A1 insignificant risk, B1 low risk, C1 moderately high risk, D is very high risk. Clear. D is very high risk. Clear. So what is the correct answer? Yes, many are giving the correct answer, that is B is a low risk. Clear. B option it is the correct answer, that is B1 it is a low risk. Clear. B1 basically it is a low risk. Clear. So as per the ECGC, it basically adopts a 7-fold classification. Clear. Basically as per the which of the following basically does not match? Clear. Basically which of the following does not match? So option number B is does not matching here. Clear. So 7-fold classification, and basically it consists of basically in 237 countries. So basically they have divided it to 7-fold. So basically first of all basically we will write that 7-fold: A1 A2, B1 B2, C1 C2 and D. This is 1 2 3 4 5 6 7. Clear. 7-fold. This one is the medium one, that is moderate risk. Clear. That is the moderate risk. That is the moderate risk. B1 it is, that is as we are going up, risk is going to reduce. As we are going down, basically risk is going to increase. Clear. So B2 is moderate risk. Clear. So above that, that is moderate low risk. Moderately low risk. And as we goes down, that is moderately high risk. Clear. Please remember in this way. Clear. Middle one is moderate risk, above that moderately low risk, below that moderately high risk. And now low risk. Now remove the word moderately low risk. Here now remove the word moderately, that is high risk. Now even if we remove the word low, that is negligible or insignificant. Clear. That is negligible or insignificant. And that is very high risk. Clear. And that is basically very high risk. Clear. So in this way, basically this risk classification it is to be divided. Clear. So in this way, basically this risk classification it is to be divided here. So ECGC basically sevenfold classification, that is basically covering 237 countries. Clear? So basically it is divided into 7 parts: A1, A2, B1, B2, C1, C2, and D. Clear? So please remember all these things. Clear? A1 insignificant risk, this one is correct one. C1 moderately high risk, this one is also correct one. Clear? Because B2 we know that basically that is the moderate risk. D is very high risk, D is very high risk. Clear? So all the points have to be correct here. Now move to the next question. Clear? So please remember in this way only after that basically you are able to understand these things. Now move to the next question. An Indian exporter, clear, basically an Indian exporter exports a certain goods to country A. Clear? Basically an Indian exporter basically certain goods to country A. The goods, however, reach country B. Clear? Basically we can say that basically they want to export the goods to the country A, but they will reach to the country B. So this risk is clear. So basically which of the following this risk is? Clear? So this risk is shipping risk, country risk, operational risk, or none of these. Clear? Or none of these. Clear? So this risk basically arises basically due to the wrong shipping. Clear? Basically this risk basically it is arising basically due to the wrong shipping of goods. Clear? This risk basically arises due to the wrong shipping of goods. Clear? Because an Indian exporter basically exports certain goods to the country A. The goods, however, reach country B. Clear? So this risk basically it is due to the wrong shipping of the goods. That is basically leads to the shipping risk. Clear? That is basically leads to the shipping risk. Basically option number A is the correct answer. Clear? Option number A is the correct answer. That is the shipping risk. Okay. Now move to the next question. Question number 198. So small exporters policy. Clear? Basically small exporters policy provides the following coverage. Clear? Basically small exporters policy. Clear? Very, very important. We have already discussed regarding that also. Clear? Small exporters policy provides the following coverage. Clear? First one is 95% of loss basically due to the commercial risk, 100% of the loss basically caused by the political risk, both A and B, or option number D, that is 75% of the losses due to commercial and political risk. Clear? Basically due to the commercial and political risk. Clear? So basically they have specifically mentioned in the small exporter policy. Clear? Basically in the small exporter policy, and that policy basically it is not more than 50 lakh. Clear? Not more than 50 lakh. Clear? Please remember these things also. Clear? That is basically not more than 50 lakhs and under which. Clear? And under which that is small exporter, that is 95% of loss. Clear? That is 95% of loss due to the commercial risk. This one is also correct one. And 100% of the loss basically caused by the political risk. This one is also correct one. Clear? So both A and B are correct ones. So option number C is the answer. That is both A and B. Clear? That is both A and B. Clear? So this one is the correct answer. Now move to the next question. Any limit sanctioned by bank under its discretionary limits is to be notified to ECGC basically within how many days? Clear? So any limit sanctioned by the bank under its discretionary limits is to be notified to ECGC. Clear? Basically to whom they have to notify? Basically to the ECGC. Clear? So any limit basically sanctioned by the bank under its discretionary limits is to be notified to the ECGC basically within how many days? Clear? Basically within how many days? Within 1 week, 15 days, 30 days, 3 months. Clear? Basically within 1 week, 15 days, 30 days, or 3 months. Clear? So what is the answer? That is basically within 30 days. Clear? So any limit sanctioned by bank basically within its discretionary limits to be notified basically to the ECGC basically within 30 days. Clear? That is within 30 days. Clear? So option number C is the correct answer. Clear? Option number C is the correct answer. Now move to the next question. Question number 200. So minimum period for which ECGC covers exchange fluctuation risk basically under its scheme is. Clear? So minimum period for which ECGC covers exchange fluctuation risk. Clear? That is basically exchange fluctuation risk under its scheme is. Clear? That is what is the minimum period? 6 months, 12 months, 18 months, 24 months. Clear? So what is the minimum period basically for which ECGC covers exchange fluctuation risk basically under its scheme is that is basically 12 months. Clear? So option number B is the answer, that is 12 months. Clear? That is option number B is the answer, that is 12 months. Now move to the next question. Home currency fluctuations against a foreign currency give a rise to, clear, basically home currency fluctuations against a foreign currency basically give a rise to which type of risk? Clear? Home currency fluctuations against a foreign currency basically gives rise to which type of risk? Clear? That is basically exchange risk, political risk, country risk, credit risk, or exchange risk. Clear? So option number D is the correct answer here, that is the exchange risk. Clear? So home currency fluctuation basically against a foreign currency basically give rise to exchange risk. That is option number D is the correct answer here. Now move to the next question. Export turnover policies. Clear? Basically export turnover policies are issued within the validity period of, clear, basically export turnover policies are issued within the validity period of, clear, what is the validity period of, and these policies basically are policies basically are issued to whom? Basically whose turnover is more than, basically we can say that basically who are providing premium, sorry, who are not turnover, basically providing premium to ECGC, clear, providing premium basically to the ECGC by more than 10 lakhs, clear, or by more than 10 lakhs. Clear? So export turnover policies basically are issued basically with the validity period of 6 months, 1 year, 2 year, or none of this. Clear? So the correct answer, that is option number B, that is the 1 year. Clear? Option number B is the correct answer, that is the 1 year. Clear? So this is the correct answer here. Now move to the next question. Question number 203. So export credit insurance, clear, basically export credit insurance to the banks to cover finance extended against, clear, basically what is, for what basically export credit insurance, clear. So export credit insurance basically is extended to the banks to cover finance extended against, clear, basically to cover finance basically extended against. First one is the overseas receivable, second one is the stock in trade, third one is the export incentives, fourth one is all of these, clear, fourth one is all of these, clear. So what is the correct answer? Export credit insurance basically is extended to the banks to cover finance basically extended against, clear, overseas receivable, stock in trade, export incentives, all of this, clear. So first A option is the correct answer, that is overseas receivable, clear. So option number A is the correct answer, that is the overseas receivable. Now move to the next question, question number 204. So as per the RBI, banks have to adopt the country risk classification published by the ECGC, clear. As per the RBI, basically banks have to adopt the country risk classification, that is basically which we have discussed, A1, A2, A3, clear, published by the ECGC, clear. So as there any compulsion regarding that or not, clear, basically as there any compulsion regarding that or not, clear. So as such basically there is not any compulsion, clear. It is basically that basically the country which have not their own risk management, clear, basically which have their own country risk management and classification, clear, basically generally they can adopt this type of risk classification, clear. Generally basically they can adopt this type of risk classification basically published by the ECGC, clear. So this one is true, not, basically this one is totally false, clear. So option number B is the answer, that is false, clear. Option number B is the correct answer here, that is false, clear. Now move to the next question. In 1957, clear, basically in 1957 the government of India basically established, clear, in 1957 basically the government of India basically established. First one is Exports Risk Insurance Corporation, Export Credit Guarantee Corporation Limited, Export Import Bank, or option number D is none of the above, clear, or option number is none of the above, clear. So in 1957 basically the government of India basically established Export Risk Insurance Corporation, Export Credit Guarantee Corporation Limited, Export Import Bank, or option number D is none of the above, clear. So basically what it established, clear, there are basically two types of question, clear. One institution is established in the 1957, basically other in the 1964. Clear? So basically the institution basically that is established in the 1957. The government of India basically established the Export Risk Insurance Corporation. Clear? Export Risk Insurance Corporation. Clear? So option number A is the answer. That is Export Risk Insurance Corporation. Clear? Now move to the next question. In 1964, the government of India basically established. Clear? Basically in 1964, the government of India basically what it established. Clear? One student is already answered that question. ERIC, ECGC, EXIM, Exim Bank, or FEDA. Clear? Foreign Exchange Dealers Association of India. Clear? So basically in 1964, the government of India basically established Export Risk Insurance Corporation, Export Credit Guarantee Corporation Limited, Export Import Bank, or Foreign Exchange Dealers Association of India. Clear? So what is the correct answer? Option number B is the correct answer. That is Export Credit Guarantee Corporation Limited. Clear? All these things basically we have discussed under the part 1. Clear? All these things basically we have discussed under the part 1. Directly straightforward questions. Clear? Sometimes basically you will get these types of questions in the examination. Clear? So please remember these types of things so that we are able to answer the question. Now move to the next question. Banks can obtain, clear? Basically banks can obtain basically financial guarantees of the corporation on whole turnover basis. So banks have to report to ECGC basically on which basis? Each time a new exporter is sanctioned with the limits. Clear? So basically what they have to check? Clear? Basically they have to report. Clear? So banks can obtain basically financial guarantees of the corporation on whole turnover basis. So banks have to report to the ECGC basically on annual basis, monthly basis, weekly basis, or bi-monthly basis. Clear? That each time a new exporter basically is sanctioned basically with the new limits. Clear? Basically with the new limits. That is basically they have to basically report to ECGC basically on a monthly basis. Clear? On monthly basis, each time a new exporter is sanctioned within the limits. Clear? So option number B is the answer. Now move to the next question. ECGC has 7 type of financial guarantees. Clear? ECGC basically have 7 type of financial guarantees basically to offer to the export financing banks. Clear? Basically 7 type of financial guarantees basically to offer to the export financing banks. Clear? Out of these, the guarantees basically which is related to the mitigating losses, if any, occurred by a bank in India by taking up the business of conforming a letter of credit and taking up the documents drawn there under is called. Clear? And taking up the documents basically drawn there under is called. Clear? First one is the export finance guarantee, transfer guarantee, export production finance guarantee, letter of credit guarantee. Clear? Basically letter of credit guarantee. Clear? To the export, basically these are the guarantees basically to the banks. Clear? Basically these are the guarantees to the banks. Clear? So out of these, basically the guarantee basically which is related to mitigating losses, that is to reduce the losses if any are incurred by a bank in India. Clear? Basically by taking up the business of conforming a letter of credit and taking up the documents drawn. So option number D is the answer. That is letter of credit guarantee. Clear? So here basically what is the correct answer? That is the option number D is the correct answer. Letter of credit guarantee. Clear? So please remember these things. Clear? So please remember these things. Now move to the last question of our today's discussion. The type of the credit risk where non-performance by a borrower or counterparty. Clear? The type of the credit risk basically where non-performance by a borrower or counterparty because of restrictions basically imposed by a sovereign is known as. Clear? The type of the credit risk. Clear? Basically the type of the credit risk where non-performance by a borrower or a counterparty. Clear? Basically where non-performance by a borrower or a counterparty because of the restrictions. Clear? Because of the restrictions basically imposed by a sovereign is known as. Clear? Because of the restrictions basically imposed by a sovereign, basically it is known as downgrade risk, counterparty risk, default risk, country risk. Clear? So what is the correct answer? Option number D is the correct answer. That is the country risk. Clear? Option number D is the correct answer. That is the country risk here. Clear? Hope all the questions are clear to all of you. So in this session, basically we have to discuss up to this much point. Clear? So in the next session, basically we have to discuss some more questions. Clear? So thanks to all of you for joining this session. And I request to all of you, please do revision all these terms and conditions so that you are able to answer all the questions.